Understanding loan grading, its importance in credit risk management. Loan grading is a crucial aspect of the financial lending landscape that significantly influences the decision-making processes of lending institutions. It serves as a classification system that assigns a quality score to a loan based on numerous factors, including a borrower's credit history, the quality of collateral, and the probability of repayment of the loan principal and interest. This detailed examination allows lenders to manage the risks associated with lending while promoting responsible borrowing practices. Key elements of loan grading. Definition and purpose. At its core, loan grading seeks to evaluate the creditworthiness of borrowers and the associated risks of lending them money. Key purposes of a loan review system include identifying credit weaknesses. Banks can pinpoint loans that may pose credit risks, allowing them to implement strategies to minimize potential losses. Monitoring trends. It can help identify emerging trends affecting the collectibility of the loan portfolio, which is essential for proactive management. Regulatory compliance. Lending institutions must also meet financial and regulatory reporting requirements, making loan grading critical for maintaining transparency and accountability in financial operations. How scoring works. The loan grading process typically considers several indicators of credit risk during evaluation. These indicators may include but are not limited to credit score, an assessment of the borrower's overall creditworthiness. Guarantor support, the financial backing available for the loan from guarantors. Repayment history, historical data that indicates the borrower's past ability to repay loans. Cash flow, the borrower's current and projected cash flow to ensure that they have sufficient funds for repayment. Projected yearly expenses, anticipated costs that may affect the borrower's ability to pay back the loan. The loan grading system. While there is no universally adopted system for loan grading, it is necessary for lending institutions, especially under requirements set forth by organizations like the Federal Deposit Insurance Corporation, FDIC. This ensures that all lending institutions maintain a systematic approach to loan review. Approaches to loan grading. 1. Qualitative judgment. Smaller community banks often employ an expert judgment system where a loan officer uses their expertise and experience to assign a grade based on a broad assessment of risk factors. 2. Quantitative scorecards. Larger financial institutions may rely on more sophisticated models, including statistical scorecards that quantitatively assess credit risk. These can be adapted to account for qualitative insights. 3. Complex evaluation techniques. In bigger banks, specific departments specialize in loan reviewing, creating a more structured and in-depth analysis process. This can include the use of advanced algorithms and financial modeling techniques. Importance of loan grading. Proper loan grading is critical for financial institutions for several reasons. Risk management. It aids in accurately identifying and mitigating credit risks, aligning lending strategies with an institution's overall risk appetite. Capital allocation. By understanding the risks associated with loans, banks can make more informed decisions regarding capital allocation and reserve requirements. Loan portfolio monitoring. Loan grading allows institutions to continually reassess their portfolio's health and adjust their strategies accordingly over time. This ensures financial stability and long-term viability. Conclusion. Loan grading is more than just a classification system, it plays a pivotal role in ensuring the stability and integrity of lending institutions. As the financial landscape evolves, the importance of a robust loan grading system becomes increasingly clear, enabling banks to make informed decisions while promoting responsible lending practices. Understanding this process not only aids lenders but also empowers borrowers to approach their financial obligations with knowledge and responsibility. As financial markets continue to shift, effective loan grading will remain essential to fostering healthy economic growth and maintaining trust in the lending system.